on how to reform the EU single market. Please be aware that there will be a Q&A at the end, but also you may submit your questions online already using Slido. That's at slido.com using the hashtag EUcompetitiveness. So the single market, with almost 450 million consumers, is often flouted as the EU's greatest achievement. Prices are lower and EU GDP is on aggregate, on average, 9% higher than it would be without integration. But it's far from done, with varying levels of integration across the freedom and across the different countries. Some estimates suggest that achieving further integration could deliver significant gains, but for the past 10 to 15 years, progress has stalled. The new Commission has the chance to tackle this head-on, and indeed there is heightened focus on strengthening the EU single market. The former Italian Prime Minister Enrico Letta has been tasked with a report on this very topic. Read our interview next week. And also another former Prime Minister, Enrico Draghi, has been tasked with a report on a similar connected topic, how to enhance EU competitiveness. But will this all purely be lip service, or will this time be different? We're here with an excellent panel of speakers to try and address some of these questions. In turn, let me introduce Outi Slotboom, and I hope I pronounced that right, Director of Strategy and Economic Analysis at DG Grow at the European Commission. Jacques Pelkmans, who is Associate Senior Fellow at CEPS and Visiting Professor at the College of Europe. William de Vijlder, Group Chief Economist at BNP Paribas. And joining us online and hopefully on the screen very soon with us is also Frank Niederländer, who is Head of Governmental Affairs of Europe at BMW. And just before we start, here you go. Welcome to Frank. Just before we start, though, I wanted to welcome Lenchant, who is advisor at the EIB representative of the EU, to give us a brief keynote speech.
Ladies and gentlemen, good afternoon, and thank you very much for inviting me here today. Good planning as well in organizing this event 1 week before the publication of the Letta reports. 1 week before the Letta reports, but also about 9 weeks before the European elections. With the upcoming elections in June and later in the year, the elections in the US, we are in the midst of a fascinating transition year. So one may wonder, what will be the priorities of the incoming European Commission? For sure, competitiveness will be high on the agenda. So, and therefore it would have been interesting to see a joint publication of the Draghi report together with the Letta report, because of course they both go hand in hand. Looking at it from a single market angle and also from the perspective of my employer, the European Investment Bank Group, the notion of competitiveness has a very clear echo in the Capital Markets Union. And unfortunately for now, it's more capital markets than any union. And that's a pity, because fragmented capital markets hamper our competitiveness in the single market. And why do I relate that much to the need to complete the Capital Markets Union? It is because it has an enabling role, and a type of role which is also part and parcel of the core mission of the European Investment Bank. I will come back to it later on. Yet for the capital markets to make a difference, they need to be put at work, notably through the reconciliation with investment gaps that we face today in the EU. And it's good to see that there is momentum now. The Capital Markets Union has come back to the surface and seems to be on the radar of the leaders. And just recently at the Eurozone Summit in March, the German Chancellor highlighted the importance of performing capital markets. The file also figures prominently at the next special European Council of next week, 17 and 18 of April. And tomorrow, ahead of that meeting, the ambassadors will have a first discussion in Coreper. More importantly, we no longer speak of the need to have performing capital markets. No, Chancellor Scholz, he referred to an urgency. And now it becomes interesting, actually, because it happens to be that in times of crisis and urgency, the EU has this remarkable ability to close its ranks and do what is necessary. So there is hope. Because today it is urgent to address the investment gaps through an intimate conjugation with the Capital Markets Union, both with investment gaps, and the Capital Markets Union. That's of course because both are intrinsically intertwined. One prominent investment gap is the need for more financing for innovation, a key driver of competitiveness. This gap also emerged again in the latest EIB investment survey. It's a survey which we carry out every year with about 12,000 companies across the EU. And what we see is that Europe is a global research and innovation powerhouse and a leading economy in terms of investment in R&D and number of researchers. And although Europe has increased indeed its R&D investments over the past 2 decades, it's still below its target of 3% of GDP. Europe simply underperforms compared to the US. It's not a surprise. It's not new. We have lost ground in key technologies and are slower in the process of generating new leaders, particularly in the most competitive new technologies. And just to give a couple of illustrations through patents. For digital patents, both the US and China deposit more than twice the number of European patents. In the remit of AI, it's the same, where China deposits more than double the number of EU patents, and the US even more than 3 times. In the EU, highly innovative firms suffer from a lack of suitable finance, which basically limits their ability to grow. The financing gap of high growth companies is linked also to an underdeveloped capital market. And the EU venture capital market lacks appropriate instruments, scale, risk appetite, and also skills. And despite progress, regulation can also be improved, notably when it comes to a truly unified IPO market or the harmonization of insolvency regimes across the EU. They undermine, for now, the single market, or at least its full potential. In addition, R&D spending is highly concentrated in some EU member states, which results in a scientific and technological divide. And when we talk in terms of global competition, we need to better translate our fundamental research into tangible, commercial, innovative products and services. It is exactly that ability that provides the single market with a competitive edge on world markets. Also here, a very telling illustration. According to the International Federation of Robotics, and it was referred to in, I think, Financial Times a couple of weeks ago, in 2022, 52% of all industrial robots in the world were installed in China, up from 14% just a decade earlier. In the EU, we are far from that, and that really needs to change. For innovation, you need also adequate financing. Also, the financing itself needs to be innovative if you want to succeed. Basically, there is no shortage of money, but our capital markets are less fluid than those in the US. It's a question of getting the money there where it can support innovation. Just imagine what could be achieved if we could put just that of a portion of the European savings at work for European innovation. And here the EIB has a role to play. The EIB Group is one of the largest public supporters of innovation in the EU. Since 2000, we have invested about 270 billion euros in innovation. And we do so in all segments of the value chain, from fundamental research in industry over clean tech to bio and also medtech. Through the European Investment Fund, a subsidiary of the European Investment Bank, we are also one of the largest providers of venture capital in the EU. And you know what? We are not that happy with that leadership because it exactly shows there is such a gap in the markets in the EU. As such, the EU has supported almost half of Europe's unicorns that have emerged in the past 15 years, such as Skype, WeTransfer, Spotify, just to name a few. In general, in the EU, we need to take more risk when we invest in innovation. And this brings me to an enabling role of public policy instruments, a key factor in the single market. You can take more risk when you share the risk. Risk sharing is a key element of the EIB's engagement in EU programs such as InvestEU and Horizon Europe, where we are a key partner to the European Commission and work very closely together. It is basically the basic idea that by reserving a part of the EU budget, a guarantee is provided which allows players such as the EIB to take more risk and make a difference. And in this way, we are able to finance projects that otherwise would not have been able to be financed, or at least not to the same extent. You can imagine, typically it's about more risky projects, such as highly innovative ones. Not only are we able to take more risk this way, we are also able to crowd in private capital. And more than ever, we need more private capital to flow to research and innovation, especially in times of increasingly constrained public budgetary resources. Traditional commercial banks are not up to that task. There's a clear need, so, for EU policy instruments to play their role in the single market, and it will come not as a surprise, I think, that contributing to the Capital Markets Union and completing it is one of the 8 priorities of our new EIB President, Nadia Calviño. Ladies and gentlemen, the current fragmented Capital Markets Union also means that financing is inadequate to support the scaling up of top-notch companies in the EU. Once promising innovative startups reach a scale-up phase and are confronted with a lack of financing, other parties from around the world are more than happy to harvest what we have helped sowing before at the start. And to help remediating this conundrum, we have launched, together with a number of member states, a scaling up initiative called the European Tech Champions Initiative. It's basically a fund of funds that will channel much needed late-stage growth capital to promising European innovators. It is an important initiative, but it's also just a contribution. It is clear that we need much more financing to help scale up successful startups in the single market. And the need is especially urgent for the green and clean tech sector. It's fair to say that we will not get to carbon neutrality in 2050 with the technologies that we have today at hand. They simply do not exist all yet. The whole discussion on how to tackle climate change and its intimate conjugation with innovation cannot be seen independently from the current geopolitical tensions which put pressure on the single market. COVID, the war in Ukraine, but also the economic policies of the US and China have only confirmed that we need to drastically reduce our dependency on foreign energy sources and raw materials, just to name a few. We need to bolster our own supply chains. What is basically at stake is our strategic autonomy. It's our strategic resilience. Commission regulations such as the Net Zero Industry Act, the CHIPS Act, and the Critical Raw Materials Act are all steps in the right direction. At the EIB, we are very eager to contribute to those initiatives with our own financial instruments, such as the Repower Plus initiative. Without wanting to be exhaustive, and I'm aware of the time, one more point. No innovation without skilled people. Skills are an essential part of economic competitiveness. Innovation needs to come higher on the priority lists in education and skills policies. There's a dire need for appropriate skills throughout the entire value chain, be it in AI or perhaps also in specialized finance. And don't get me wrong, it's not only about getting young people to university, it's also vocational training, which is of the essence. Not only academia is very important in the single market. More than ever, we need to be able to apply our innovative insights with qualified people at the right spots. Now, looking ahead, in order to cope with climate change, but also to stay relevant in the world, it's a basic message. It's clear that we need to invest more in innovation. It's a key strategic asset of the single market. The first proposals of the next MFF will come out, I guess, in the summer. And from what I got informally on the successor of Horizon Europe, I understand there will be more focus on the translation of fundamental research into applied innovation. And we can only encourage such steps. It's very promising. Remains, of course, to be seen whether leaders will consider the Capital Markets Union enough an urgency and give it the political priority it deserves. Let's hope for it, at least. There is now a clear window of opportunity for putting it high on the agenda, high on the priority lists, first in the strategic agenda of the European Council, and later this year in the political guidelines of the new incoming European Commission. One thing is clear, whatever direction it will go, the EIB stands ready to continue its role as an enabling financier, enabling as the Capital Markets Union could enable further unleashing the potential of the single market. And as such, we do it as a partner of the European Commission and as a partner to any innovator across the Union. I thank you.
Thank you for that overview of the next agenda for the next commission. Outi, I wanted to start with you. The single market turned 30 last year, and you at EUgrow and other services have put together a health report. So I wanted to start by asking you, what are some of the main low-hanging fruits that policymakers could try and pick to deliver progress on the single market?
Thank you. And again, thank you, Lucas, who was very comprehensive. On the single market, indeed, you said, Paola, in your opening comments that there has been progress, but progress has stalled for the last 10 years. And it is clear that we have harvested much of the low-hanging fruit already. Where, in my view, there could be more low-hanging fruit is digitalization. We have, in the past 10 years, new digital tools have become available. We can manage the single market better. We can collect information better through the new digital tools that we have. We can exchange and transfer data. We have tools in place like the single digital gateway, which is an instrument to put reports and member states exchange information from there. They don't need to go again to companies, individuals. We can also do much more data collection and monitoring through digital tools, and we can do more trade using digital tools. So that is clearly low-hanging fruit. But maybe I can turn to something else, which is not something we could have done 10 years ago, but we are now opening a new page in terms of EU enlargement and a bigger single market. We have candidate countries which we are going to integrate as soon as we can into the single market, starting from Ukraine. There is a growth program for the Western Balkans, and for our supply chain resilience, this will be a big step forward for the scale of the single market, for the scope, and also for our economic resilience. So a significant expansion and integration of the candidate countries, the single market, is a second thing that I would like to mention.
And also a source of challenges, because obviously, I mean, we have all seen, given the reduction of trade barriers with Ukraine in an effort of solidarity, this has generated some pushback from neighboring states. So how do you suggest, going forward, integrating wide and often, countries that will be competitors to their EU neighbors into the single market?
On the existing single market, we have had cohesion policies to accompany market opening, and this will certainly also be the case in the next multi-annual financial framework, in the next accompanying period. It is true that there have already been conflicts with market opening. These have to be solved, but these are individual cases, and in every successive enlargement, a larger single market has brought us more power globally. It has helped us negotiate trade differences with third countries because we represent a very large single market. So for me, individual cases of competition can be solved. Supply chains will be more and more integrated. The Commission will publish some results of the previous enlargements to celebrate the 20 years. And these will show how positive the reduction in trading costs and integration of supply chains has been. And I trust that this will also be the case in the next enlargement.
Indeed, I was researching, if you go country by country, who's benefited most, even though, it's a net positive, but overall, this has changed, and the last wave are definitely the ones that come up on top in terms of addition to their GDP, trade as a percentage of GDP, and so on. Jacques, I wanted to come to you and ask you, you've been studying this for quite some time. What do you think the priorities should be for the next Commission in reforming and advancing single market? And also, do you see this as being a real opportunity, or is political will really behind this? And how do you judge, the likelihood of progress being achieved?
Yeah, it's true that you can make, It's true that you can make long lists, very long lists, almost telephone books. In the report that I published in CEPS, but of course a number of people were behind that, you find lists till you die. I mean, and we shortened the report enormously because who wants to read a telephone book? But it does mean that there is a hell of a lot more than the things we have just said. And both speakers have been, you know, there's not one line I disagree with. So it's completely correct. By the way, also the emphasis on all this innovation, modern technology and all of that makes, push into oblivion the traditional problems of the single market, which are not resolved by far. There are a large number of things that must still be, and there is basically very little interest in it. So yes, some analysts like me look into it, but does that really have a resonance with the political leaders? I am not so sure. I'm skeptical, but I hope to be surprised. But even when you look at all these lists, this is in our tradition since 1985, all these lists. I've seen many lists. The Commission report on the single market, 30-year single, shows that despite all the moaning and the lists, we have made enormous progress in terms of hard economic analysis. So it's not that it's only negative, but it's also true when you look not at the economic analysis, but at the potential, then the lists are relevant. So if Stolz now suddenly says, I borrow from our first speaker, that the capital market is very important, can Mr. Stolz then, but he's not in the room, I think, is he? Would be nice. No? Can he explain why the biggest IPO in Europe in years, that of Porsche, last year, 75 billion euro, was not done at the European level? It would have been a golden opportunity. It was all kept in Germany. So that is typical for all these stories when some advisors whisper in the ear of a president or a prime minister that he or she has to do this or that. So it's not credible 1 year after the Porsche IPO. So I'm all in favor, but I look at the acts. I'll give you another example. Of course, examples are always a problem because there's so 100 more. But is anybody in this room aware of the décrousades laws in France? See? One. Most people have no idea what's happening there. Is it a relatively narrow thing when you look at all? The décrousades violates free movement of goods, free movement of services, and the right of establishment. And it violates the European aspect of contract law. You can hardly get more to destroy the single market, right? And yet it happens. It's in largely agricultural goods. EUROCOMMERCE calls it fast-moving consumer goods. Okay, but that's fine. But what happens there is just totally unacceptable. It completely undermines the single market by the government that says that they want to push forward the single market. I will not go on further, but if you want to train and test whether you can still cry, whether you can still weep, read the half-annual report of EUROCOMMERCE. It's depressing reading because what they do is only list a summary of laws in basically practically all the member states every half year. And it's only about violations all the time, plain violations. Some border cases, most of them are plain violations. So what I'm trying to say is, I have made a list and I'm trying to build both sort of the institutional legal case as well as the economic advantages of why it's important. Or even not only strategically important, just bloody important by itself. But I'm around for too long a time to be automatically optimistic. So what you need is, apart from these lists and taking them serious and really serious, you need a way to involve the European Council and the various councils, but especially the Competitiveness Council, to commit together with the two other institutions, but they first, with hard calendars to which they also commit. Otherwise, I'm not so sure whether much happens.
Thank you. So a message that not only about not going forward or the problem of solving, but also be aware of not undermining what we have already achieved. Perhaps a message to look at that. William, I come to you. This has been mentioned already before, but one key component single market is capital flows. And there's heightened attention to the depth and width of the capital markets union. There is a sense that, in Europe, this is too little, too fragmented. As we said, we don't have a unified place for placing one IPO. We have many, many different insolvency laws. We have a number of issues which are, again, another type of list that ministers and next week even the EU leaders are going to tackle. In the banking sector, what do you think is the view of, why are we less competitive than our US counterparts, for instance, in availability of capital?
It's of key importance, to state the obvious. And I will just, because in another question you asked about the low-hanging fruit, so I'll just throw an idea in the room, a plea, and then I will go more into detail. The plea I want to make is that somebody credible should publish on an annual basis the cost of non-CMU. Why is that key? Because there is an unawareness of what the non-CMU entails in terms of complexity of getting your projects financed. And gradually over the years, macroeconomic analysis has become far more oriented towards counterfactual analysis. We are raising interest rates because if you would not do that, the situation would be even worse. Well, we should do exactly the same thing, do a counterfactual analysis of putting in place a CMU and then calculate the cost of not having it. So that's my plea. It's not an easy exercise, but okay, I hope that some people will pick it up. My only tiny contribution in that respect is to remind readers of our weekly publication that there are diversification benefits to be had from a truly well-functioning capital markets. And if you are making it more difficult for your domestic investors, meaning EU investors, to tap these benefits, it means that by definition, their financing costs will be higher. Now, let's zoom in on some things. Christine Lagarde at the European Banking Congress last year in November gave a truly fantastic speech in which she explained the fundamental role played by the kind of opening up of capital throughout the US in the investment financing needs for the railway development. And of course, your argument was that we are now facing in Europe something similar because of these huge financing needs of the European Commission numbers, 500 billion extra investment per year for the coming 10 years. I've seen numbers bigger than that, so I always call it a bit of a ballpark number, but it's huge. To put things in perspective, it means that the investment ratio in Europe on a net basis would increase 2 percentage points of GDP, which relatively speaking would be an increase something like 20%. Yeah. You can calculate, I haven't done the exercise, but you can calculate how much can maximum be financed by the banking system, because that is really tied to how much capital regulation and what have you. And the rest has to come from capital markets. So where is it going to come from? Obviously speaking, you can expect that there would be less capital outflow to the rest of the world, because now, as an aside, we're really having a very fascinating situation. So the European Union is running a current account surplus, and I haven't checked the numbers, so it's more a hypothesis. I would need to check the numbers, but let's assume that part of that current account surplus serves to finance the huge and rising financing needs of US Treasury, which then enables US investors, domestic investors, to look at more attractive opportunities than simply financing the US budget deficit. And one of these attractive opportunities is to look at the investment needs in Europe with respect to the venture capital, as you mentioned, and other things. It's a very, but at the end of the day, we will be losing out on that, because my strong belief, unless somebody tells me that doesn't make sense, but my firm belief is that if you think about financing of risky investments in the strict sense, I mean, well thought of, but investments with uncertain payoffs, highly likely positive payoffs, but with uncertainty. So the source of the financing of these risky projects will, at the end of the day, determine where the value added of the projects themselves. I'm not talking about solar parks, etc. I'm talking about innovation at the company level, where the value added will be located. And that's why we need the venture capital. That's why we need the CMU, etc. Now, there's another thing which is key in that respect, is that where are we on risk-bearing capacity with the European Union? Another strong belief I have is that there is a total lack of additional risk-bearing capacity. I remember from my previous life, as I always called it, because before becoming chief economist of Paribas, I spent 25 years investment teams. And back then, when I was speaking to institutional clients like insurers, this is more than 10 years ago, they were telling me, okay, markets are down, I have to sell. I mean, you have a pro-cyclical investment stance dominated by regulation. If you think about MiFID II, I mean, every single year I have to confirm to my banker that I'm still have the same profile. I mean, you really need a lot of conviction and courage to adopt for a kind of a risky profile. So the point is, we also need to think about the risk-bearing capacity of our institutional investor base. It is striking in that respect, and I'm quoting an article of Martin Wolf of the FT, a colleague, I think last year. He did a brilliant article, I think it was Martin, on what the transition of defined benefit to defined contribution has meant for the risk-bearing capacity in the UK economy, and a detrimental impact for the financing of risky investments. So all these things we need to tackle. You have still 1 more minute? Yeah. So then I happen to be invited now and then over the years to kind of contribute on a discussion about CMU, what should be done, etc. The thing that always strikes me is that, one, that's just, if I can be binary, no progress, despite the importance. Secondly, I'm also, you were mentioning a long list of topics. I'm struck by the long list of topics. So one suggestion I would make is please concentrate on what is most important and leave the rest for another day. A long list of topics for me gives the impression that it allows horse trading. But if you want to do horse trading, I suspect it will take more time and there's not going to be enough progress. So we need to shorten that list. I'm a big fan about the necessity to improve financial literacy, but if you have tight MiFID II regulation, what's the benefit of financial literacy? I mean, please be serious. That's not a real issue that we're facing. And all this, I've said, is really from a financing angle, but we should also be mindful of the fact that at the end of the day, the job creation and the value-added creation, they are coming from young companies, from new companies. I mean, there's abundant research that shows a key role played by young companies in terms of job creation. So if we do not manage to get that one right, I mean, we will have issues. We can always buy licenses to use IA tools developed elsewhere, but you clearly understand that we're just paying for a license, so the value added is created elsewhere. So I'll stop here. Thank you.
Thank you. Maybe just as a very quick follow-up, next week leaders will discuss, and I mean, from draft conclusions, there will be short lists also because, you know, we don't want to be stuck in the council for too many hours, but there will be a short list of to-do actions, which leaders will give themselves and pass their ministers to carry forward. You know, some of that has to do with creating a pan-European savings product. Some of that has to do with harmonizing insolvency law. If you were to advise the EUCO next week instead of President Letta, what would you tell them? This is the one thing that you need to do to improve the capital markets union.
Well, at the risk of sounding immodest, I would definitely charge specialists to calculate, because then every single year you will be able to say to all the decision makers, the absence of progress is costing European Union and its citizens so much. So it's not a solution, I understand, but I do think it would act as a kind of a push in the back. And then find a way that risk-bearing capacity increases. Back in the, late 70s, early 80s, we had in Belgium and in France, actually Belgian plan was inspired by what happened in France, to boost investments in risky assets, in equities. Perhaps we need to think about that and roll it out across the European Union.
Thank you. And Frank, finally we come to you. Thanks so much for your patience. I wanted to talk to you about, you know, the mantra in recent weeks and months seems to be, you know, EU competitiveness, and there's a lot of soul searching on what's happening. Why is EU competitiveness declining while competitiveness in the US is outpacing and the gap is widening? And we used to have the Green Deal as presented as the Europe's economic growth model, but now some political and practical barriers are emerging to that delivering, you know, the expected growth. So what I wanted to ask you is, you know, given the political realm that we are in, what should the next Commission do in terms of ensuring that if we do pursue the green agenda, this is not a competitiveness burden, or it's either neutral or even a positive?
Thank you for having me, and thank you for the question. First of all, I'd like to pick up on what have been said before. I think we have really a window of opportunity, and that's now with the elections, with new commission. That's really the opportunity to create a new framework. I think the Green Deal, as you said, had been a tremendous vision. I was really amazed at the time when it came out. But we will also see that the circumstances has changed. The geopolitical situation has changed. The tensions in the different world regions have changed. Different regions have engaged with different industry strategies. And so the Europe has to adapt itself to that new situation. Having said that, and I hope Jacques is not right, but having said that, for me, it's already positive that we talk about industry, that we talk about new production needs footprinted in Europe, that we talk about innovation, risk capital, finance market. So these are the topics which are the relevant ones, which then, of course, have to be done by industry or businesses. But I think the EU has different awareness currently on creating enabling conditions which foster that momentum and probably which have created an urgency due to the developments in the different world regions to adopt its Green Deal and to adopt a strategy to cope with those dimensions. I think there are always different elements. Being in a company which acts at a global level, you're always forced to cope with competitive situation in the different world regions. But I think there are a lot of industry, especially in the supplier base and small and medium-sized enterprise, which often do not have that global opportunity or perspective. And that's something which should be strengthened even more in the future, and to enable those companies also, not only the big players, but also this really sound foundations of the European industry to cope with the developments in the world. And I think at the end, it's not about, let's say, changing from a Green Deal to industrial deal, but both are very complementary. The new technologies, it's our growth business. I think as every growth business, and we had this discussion earlier on startups, it's a question about how those technology, how those markets are ramping up. We have seen, especially, for instance, in last years on the electrification market, a ramp up at the beginning, supported to subsidies from different governments. But once those subsidies have cleared away, the markets came back, and we have seen the backsplash. I think in the long run, the transformation will be coming. The question now is, however, how will the market take up, how the infrastructures are coming up, how customers will react. So that's a long-term process. To coming back, I think it's good to talk about an industry deal. It's good about talking about the competitiveness. I'm also happy to see the complementarities on the both reports, the latter on the single markets and Draghi on competitiveness. Our single market is a big asset. It's a big asset for growth internally in Europe, but also in terms of balance our competitiveness in a global world.
Thank you. Your sector is one that is quite good for exemplifying how much Europe needs to rely on open markets, both for finding customers abroad and for global supply chains, but also facing increased competition from abroad. And recently, I'd say over the past year, but perhaps even a little more, the EU has taken a little bit more of a, if not aggressive, at least defensive stance when it comes to competition from the rest of the world. We've seen that recently with probes launched against, solar panels from China. We'll see more of this tomorrow from the Commission. And generally, I wanted to ask you, when it comes to this kind of trade defense tools and geopolitical different stance of the EU vis-a-vis the rest of the world. We have heard a lot of slogans about open strategic autonomy and so on. Is this something that's welcome by a business like BMW? And how do you straddle the need for keeping open markets while at the same time, facing strong competition and sometimes unfair competition from abroad?
As I mentioned, competition is a key of our business since ever. So it's nothing new at that respect. But we are also at the same time very advocating free trade, because we believe in several aspects of that. One, as you said already, and that's also something for our European competitiveness. European companies should be competitive in different markets. And by that, it's something which is not relevant only for our local market, but also for the export and creating wealth and growth for Europe by export. But it's also relevant in terms of innovation. I think as European companies, we should be open to find and take innovations wherever we have it. Currently, we have probably more a flow from Europe, knowledge, patents from Europe to other world regions where the capital market, investment market, is better. So gaining those innovation and bringing them back to Europe as we do it in the car industry, I think it's a very strength for Europe at the end too. I think you mentioned also the value chain. It's very much global. We are not able, especially in the new technologies, to be autonomous in the near future. Any studies on raw materials, processing of raw materials, on capacities, on key technologies, on green technologies, depend on global value chains. So giving up those, protecting up those would bring Europe's competitiveness back to a different situation. But it's also clear that we need to balance the trade element. Fair trade is a very important element. I think there's the WTO, which gives the measures. And last but not least, you have seen different strategies. We had talked about China, but you had also seen the IRA in the US. So you see different world regions creating industry policies, industry strategies. And I think that's now at Europe's step to create its own one and perhaps find a hybrid way between the current mainly dominated regulation pathway in addition to more incentivized and looking perhaps more on enabling conditions. But I don't believe that we can really protect ourselves and isolate ourselves in that global world.
Thank you. Indeed, maybe, you know, we have had the sticks, where are the carrots in terms of incentivizing
we
more
know that
competition?
Exactly.
I wanted to maybe return to the reason we're here and the timing. So there is these two reports coming out, and you know, they're not the first, they will not be the last, of asking prominent figures to look into the single market or other issues. But I wanted to get from all of you maybe, what is your wish to see in them, and also how should they be used? But I'll start with you, Outi.
Thanks. So obviously we are not writing the reports, we are looking forward, but with great expectations for a more visionary look to the future, a fresh independent view from both gentlemen on how to move forward, and how, in particular, how not to look back and try to see what should have been done 30 years ago, but maybe really to see. And 30 years ago, I was assistant to Jacques, who is sitting next to me. So, and this is why I'm sitting next to him now, because I had this great training in my earlier years. But the world has changed a lot. And as many of the previous speakers have said, the geopolitics have changed. The rules-based multilateral trading order has weakened significantly. The EU is competing with strong resilience policies in other parts of the world. The Inflation Reduction Act, which may attract investments from the EU to the United States, and that's a challenge we have to address. The China policies, sometimes export controls. The whole resilience agenda is something which I think creates a different perception of risk now. Companies, when they noticed during the pandemic that if you only import your raw materials from China, and then suddenly all the deliveries may come to a halt because factories closed due to the pandemic. That must have been the final wake-up call to see what risk means and what diversification could bring. And many governments have noticed that it may be a good idea to have stockpiles of face masks or have the capacity to produce vaccines. And this idea of crisis preparedness and a different perception of risk and being prepared to face risks which may cost money, that is something that we have to face. And secondly, climate change, a huge agenda. As we just heard, the Green Deal and Industrial Deal can be complementary, and this would be the best outcome. But this also implies a cost in terms of becoming more energy independent in the EU, in terms of moving into cleaner technologies, changing our production methods. So for all this, we need We need more investments, and we heard from the EIB how they are helping. We need policies like trade policies, which make sure that we are not alone in fighting climate change, or that we do not create a huge competitive disadvantage to European companies because we are pursuing Green Deal policies. And it is also very much in this context that I would personally like to hear from Mr. Letta and Mr. Draghi how they see European competitiveness in the future context and in the context of EU enlargement, which I mentioned.
Thank you for that. Does anybody want to jump in? Otherwise, I'll pick a couple of questions from the audience. What's your desiderata? Go ahead.
We can make many lists, but there are a number of big things from the past, not small things, but there are also small things, that have not seriously been addressed. And that's in two types of services. Services under the Services Directive and services that are regulated, like financial and all these various services. There, I don't see real serious program, and I don't see determination in the Council. And if you ask the people who 10 and 5 years ago in DG Grow led the services, these people have, DG Grow has been reorganized because of total frustration. That's my interpretation. Total frustration with the Council. So that's where it has to begin. So that's why I would like to rephrase your sentence. No matter how good it sounds, you said, look into the single market. No, commit. That is what the Council has to do at the high level and at the operational level with the Competitiveness Council, and then see these commitments to be together with in the calendar with the Parliament and the Commission. And I'm sure the Commission can then work it out. They're only too keen to do that. Without that commitment, yeah, we just pile up reports. So I wanted to say that I have more to say, but I will swallow that.
Thank you. Do we have a roving mic, and do people have questions for our speakers? Please put your hand up. If not, no, nobody? Very shy. Oh, lady over there, please state your name, who are you speaking for, and keep it to a question, please.
Hi, my name is Jamili. I'm a former journalist and student at Lund University. I wanted to ask about regulation, especially in the car industry. Some more innovative companies sometimes struggle to meet both regulations from the US and EU when they're trying to target both markets at once. And I wanted to ask if this is actually a concern and how it could help the single markets to address that. Thanks.
Frank, I think it's for you.
Yeah, try to answer. What's true that regulations worldwide are often very different. Sometimes it had been also a non-tariff instrument to steer that. I'm not sure whether it's a single market issue because within Europe, harmonization is done, so regulation is more European one. I think that the more relevant element you mentioned, perhaps it's really the innovation part. So I'll give you an example on autonomous driving. For instance, we currently have a level 3 system, which we were able to license in Germany. We now made the next step to bring it to different European countries, but we were earlier be the first one having that license for that autonomous driving system in China. And that's something where I would refer to your point that speed and flexibility could be a new paradigm for an industry policy and a dialogue with, let's say, EU institutions to foster that competitiveness, especially as you mentioned, on smaller companies or startup companies.
Thank you. While the audience thinks, maybe I'll direct some of the questions they received on Slido. And again, Outi, I'll pick on you, but there's a question of over-regulation, and the Commission has taken an approach to try and reduce the amount of regulatory burdens that companies face in the EU. That's also seen as a factor which can hinder competitiveness vis-a-vis other actors. And there's a question here saying, To overcome the single market's fragmentation while still safeguarding the fundamental freedoms, should the EU embrace an increasingly regulatory approach or not, or the opposite? So are we going in the direction of too much regulation, therefore kind of like throwing, as we say in Italian, shooting one's own foot, or do we need more to achieve the goal of the single market?
Let's first start from the basic fact that the single market is very often 27 national rules replaced by one EU rule, which facilitates the single market and which allows companies to operate in this area. There are new areas, and of course the Green Deal has been raised several times. To address climate change, there have been new rules, and this clearly has led to some addition of rules. The Commission is very much aware. Everywhere where I go, I hear complaints about over-regulation, but indeed the agenda of eliminating any unnecessary burdens is very close to our heart. We have as the process the impact assessments, whereby every time a legislative proposal is prepared, every director, including myself, goes to our regulatory scrutiny board to explain why this is a good and lean, efficient proposal, and comes back and receives a letter with huge criticism, rewrites the whole thing and tries a second time. So the internal process is quite hard. We are increasingly moving into testing and sandboxing, testing regulations which would allow innovation. We are trying to measure all the administrative burdens arising from the EU regulations, which is a huge task. It's ongoing and has already led to 41 proposals to cut the reporting burdens. And there's special attention to SMEs. But the question is, do we need to regulate in the first place or not? And of course, I personally believe that there are many areas where we need to regulate. And the EU has been a world leader in many areas of regulation. There is literature starting from Anu Bradford marking the Brussels effect, which means that when there is an EU rule, third countries copy the same rule to have better market access, but also because the rules are seen to have the quality. But we have, we need climate rules, we need social rules, we need the basic rules to have the single market run. And as a second point, I would like to come back to what Jacques just said about the Council, which is our ally of the Commission, not enemy. But it is true that and we like reorganizing to be efficient. In my long Commission career, I don't know how many reorganizations I have seen for different good reasons. But effective enforcement of rules is very important, and the member states in many cases can do more. The problem is not always the EU law, but the fact that it has been transposed with gold plating. The national rules are not what the EU legislator had in mind, or that they are not enforced, they're not respected, and my colleagues can chase the member state authorities and launch infringements and take them to court. But we still feel, and maybe this is an additional wish for the report of Mr. Letta, indeed to put more emphasis on member states thinking about the single market dimension when they enforce and implement EU laws.
Thank you. I'll have a variation of a question that was asked, and you mentioned the Brussels effect. I wonder if, we can also have a reverse Brussels effect where we learn from other actors on lessons that could be applied, that could work here. And William, one of the issues that finance ministers in particular are looking at is, the US does it better in many ways in the capital markets. It has a much more developed equity market, securitization is much more developed there. What and how can we import from the US, if we should at all, into EU capital markets?
I think you're a bit generous vis-à-vis the US. I mean, they have been able to create some bubbles with global ramifications. Other countries have also seen bubbles, so it's not unique to the US. But I think you have a number of attributes in the US that give them, comparatively speaking, a strong position. Think of 401k plans. I mean, this is pretty interesting. It entices people working in the company to put some money aside and then preferably to invest in other companies in their own company, because otherwise they concentrate risk, of course. So that's one point. Another point is the assumptions you make in terms of expected returns, which admittedly are sometimes outlandish or have become at some point outlandish. So, okay, that has gone too far. But on the other hand, it does mean that people, that institutional investors, I'm thinking of foundations, pension funds, endowments, that have an ability to take a very long horizon, because they're not so much confronted with this pro-cyclical risk reduction obligation when markets turn south. So these are just two examples. I think we should be aware of the fact that you have a phenomenon of the winner takes it all. And that's very important. So I think if we are able to make progress along the lines of CMU here, is that gradually we start building. But otherwise, it's really the winner takes it all. You have deeper markets, meaning more liquid. You have a broader range of assets. You have the people on the management side, asset management side, that build businesses to do this. And then you have people on the listing side and on the capital market side that are also so, and it just acts like a magnet. Recent research has shown of startups and venture capital companies that the US is so attractive because you have the combination of one market with one set of laws, with one language, and you have one capital market. So you have both, let's say, the financing and the real economy. So that's very powerful. So that we need to reflect upon that. And that's why, for instance, a couple of months ago, there was this big conference in Las Vegas, and there was Belgian very young people who had created a startup and that set up shop in the US. And they said, well, we have the financing straight away, and we have one market straight away. So, so that is what we need to, and as you mentioned earlier, you have brains and what have you. This is all great, of course. Although with the PISA scores that are in the report on the single market going down, and we've seen about it as well in other media coverage. This is a bit of concern, but I mean, it just strikes me that there are countries in Europe where the word dividend is almost like a bad word. That is, people are saying that I mean, the report that I dread most every single year is how many billions of dividends have been paid out. I mean, what's the value out of that report? One, it's nil. But secondly, it's actually negative, because then people start to say, well, my goodness, who has received these dividends? And, if you have any investment as a future pensioner, if you have life insurance policy, or if you have invested your own money, I mean, you would be keen to at least have a correct remuneration for the risk you're taking. So these are just many things that we need to address. But it's going to be a long-lasting effort because of the winner takes it all phenomenon.
Thanks, sir. Outi, and then if there's a question, otherwise I have a follow-up.
Now, just to come back to your question, which was before you specified about Capital Markets Union, do we ever learn from the laws of third countries? Does the Brussels effect work in the other way? I want to give two examples. One is on this economic resilience agenda, economic security. We have looked very actively for years already at what other countries across the world are doing. We are analyzing what the United States is doing, how they work with companies when something critical is needed, how they collect information, get CEOs together under the Defense Procurement Act. We have looked at what Japan does, how they work together, government and companies, to have stockpiles of critical goods. And if anybody is interested in reading, we published in last year's Single Market at 30 and in this year's Single Market and Competitiveness report. And we have published a scoreboard, which is on the website, a little commercial spot here. But we have published a huge annex looking at the resilience policies of third countries. And we have published that out of interest, but also because there may be things for us to learn. My second example is the United States Inflation Reduction Act, which has been rather successful. And one of its most successful elements is that if you invest under these rules, the whole permitting procedure is very fast and very simple. The rules are extremely simple. If you want to invest in the EU, you have to apply for lots of different permits. It is costly, it is much more complicated, and it takes years and years. And there is work in our Single Market Enforcement Task Force between the Commission and the Member States to look together at the permitting procedures in the Member States and to see whether we can also do a better job to allow investments to get the necessary permits faster.
Can I come also back to one of the things that various people mentioned? Because on the one hand, we also can look at innovation and startups. Oh, sorry. But why are they not scaling? They are, of course, sometimes scaling up, but not nearly as much, or they go abroad and scale up. So we must work on that. It's all very nice to say scale up in the United States, but we want to do it here. And it's like a cry as if nothing has happened, but nobody ever mentions the unitary patent existing not even 1 year. The unitary patent is exactly about scaling up. And so if a startup has a unitary patent, it's immediately applicable to 25 out of the 27 new countries. And the other two will come, I bet. So that's one thing I want to say. That's not the only problem, but it's a huge progress compared to having national patents, which first of all, very expensive. So if you are a startup, you don't want to do that, or you're very shy. And it's conquering market after market. So I want to make that point because nobody has woken up to this unitary patent. In my report, I do the first early statistic, and I think there are a number of lessons there. The other point is about CMU. Of course, I all agree with the kind of things that have been said, but I also want to say what has not been said. Now, in CEPS, we have a Capital Market Institute already for 20 years. And I think I am not in there. I am in the more broader things, but I think they are highly specialized. They have very good lines to let's say, the capital market industry, so to say. But there are a lot of vested interests. Why don't we have this capital? And people always say, yeah, it's about a certain type of risk. But it is the banks that often do make the problem much bigger. So if the banks still stick this, so this Porsche example is one example. Why does it happen? But there are many. So I am a totally independent analyst, but I'm practically the only one who say that it's the banks that frustrate the common market, the big banks in Europe, and in various ways. Now we have written a number of reports in CEPS, and the banks are, because they're in the institute, they're always there. but we have become little by little bolder. And if you are a good reader, it's very easy, in 22, beautiful report, very detailed. So if we start where the main problem is, and that's harmonization is an issue, but in my view, it's really the banks, mostly the European banks. And it's time that a spade is called a spade.
William,
Okay,
you had a frontal attack. So.
The banks are the blocking factor?
Well, I could, but then CEPS is shot in the foot.
No. I mean, I just want to make a point that you make a statement, which I've recorded, in front of the audience. No, it's not. Don't take it personally. I look at it as a debate between economists, so fine. I happen to work at the bank. But the point I want to make is that here in the room, and then I don't know how many people are online, you make a point that the banks are blocking. Okay, can you just give some examples why they are blocking?
I'll be happy to do it even on paper. Sorry.
No.
You're right.
I mean,
be happy to do it on paper.
I think, you know,
this
debate.
This is a very important statement you make. So I just, I just want to understand.
So as a rule of debate, please, you know, you make an interesting point, but please.
Yeah, and I am happy to write it up, but I'm not going to say it now because we are, not we, but the Institute is totally dependent on banks. So there is a bit of a circular problem there. And I am the independent person out, but I'll happy to write you.
Okay, well, so I'm expecting that. For the time being, the audience will not be surprised that I do not tend to agree to put it in understated English. But let me give you one example, is that the thing about where Porsche was listed, frankly, I haven't read the file. My hypothesis is that you have a German company. I think there's political capital in where it is going to be listed. There may have been an impact on how much it would cost, and there may have been even an impact on the price earnings multiple at which the stock would be trading. So perhaps, I don't know. I would not consider that as an example for the banking sector blocking progress on CMU. Quite to the contrary. I mean, the banking sector has been advocating, pleading, begging, and what have you, to make progress on CMU. I've mentioned the word dividend, and I'm going to just put it as mildly as possible. But let's say that I was struck after the global financial crisis that in the European Parliament Commission, that Michael Lewis was invited to come and explain what securitization is about. Great writer, great analyst. But for me, this is like, I mean, does this cover all the dimensions? Why is it so difficult to make progress on securitization? Although everybody understands the necessity, still today, despite all the regulation that has been put in place and making banks more resilient and what have you, still today, there are circles where you mention the word securitization and people say, oh, this is all going to be the same issue like poor quality asset-backed security CDOs. I mean, sorry, the world has moved on. So let me give another example. Banking union. We have not been able to finalize banking union yet. The key issue being what capital charges do you put in place on sovereign debt? Banks are very often criticized for not being courageous enough to embark on the M&A path. If you calculate the capital surcharges that would entail, it is simply prohibitively high. If you take into account that you have to pay a premium to the shareholder of the banks that you would be looking at to take over. We should really wonder whether the way that liquidity is being supervised in the European Union and the Euro area, whether that is allowing an optimal flow cross-border of liquidity. So these are just some examples. Now, I hope they kind of give a little bit of counterweight to the statement you've made, and I can only, I would say, request that in the CEPS publications, the point is being addressed and where the cursor is. I mean, if there is clear evidence that that the sector is digging in its heels or whatever, and then you need to wonder why that would be the case. Then please, I mean, what is the vested interest, right? Don't you think that European banks would benefit from an easier environment in which you could have M&A activity in the financial sector?
Gentlemen, I'm going to stop you on the...
Just one final point.
Just derailing a bit.
If you simply look at the way that the economy is financed, who are the actors? I mean, they are dominated by the Americans. Banks in Europe would be keen to play a bigger role in that. So I'm going to stop here.
Okay. Well, definitely there's room for a different discussion on banks, good or bad, in advancing the Capital Markets Union. But I think unless that there's two questions. Wow, okay, now it's come a bit late, but I'll give two questions. One to the gentleman with glasses over there, one to the gentleman in the front, and then I think we'll have to call it a day. Can you raise your hand, please?
Can you hear me?
Yeah, or just speak up.
Hello. Yeah. Thank you very much, Jacques from FGS Global. One question to Jacques. You mentioned that you've put together many lists exactly. And so my question would be, looking at the likely outcomes of the European elections in June, keeping that in mind, what would be on top of your policy asks that is not just idealistic, like maybe the Capital Markets Union is a bit of a long shot, but what would be most realistic and most achievable for you to really put on top of the agenda? And the same question goes perhaps also to Frank in the automotive sector.
And 1 minute.
The report is not written in terms of politics, although every section in the report has always 5 lines or so to the political leaders of Europe, right? So that's very short what they should do. It doesn't say how they should organize themselves in the parliament, in the elections, and so on, because that's often different or vague on purpose to keep. So that's not a sport that I am good at. If you are an independent analyst in an independent economy, you don't want to be led by politicians, right? Even politicians that used first to be good analysts and as a politician, they turn very different. So in that sense, I cannot help you, but I have said already today, and that's in the report, that nothing serious, I mean, marginally maybe, will happen after June, even when there is a shift in the European Parliament, or even not. If there is no hard deal between the Council, first, with hard data calendars, promises, and then agreed with the Commission that would do the details, and the Parliament with calendars for, let's say, 3-4 years. If that's not happening, so that you can call a political element, but that is born out of experience. The single market is not something that most national politicians who are in the Council think they can get a lot of political applause for. It also takes too long, it's too nitty-gritty. So they see the point, but they will not be very happy with it. That's why.
Thank you. Frank, maybe to you, if you wanted to chime in on the ask for the next Commission agenda. So there's been a lot of talk about the potential tension between sustainability and advancing European industry. What will be your plea for the Council as it draws up its strategic agenda, or the Commission as it writes its agenda for the next mandate?
Happy to do that. I think, first of all, I'd like to quote Commissioner Šefčovič lately, who mentioned we have a Green Deal, but we don't have a business case. Or he came from the Americans and they said we have the business case for that. And I think that's a very strong message which is needed for the next Commission. So again, the innovation, the ideas came from Europe, but the business case have been done by the US in that respect, and China's coping up with that. So I would like to bring back a little bit of optimism in our discussion and to say, okay, we need a kind of new energy, we need a kind of new vision and self-confidence as European to move forward, and finding that business case for us. A strong element of us, I still believe on that, is less regulation. I heard about the comments earlier on, and I know that's a very big topic all over, and statistics showing that regulation is going down, and there are good examples. In our belief, we need less regulation, so we need the additional incentive element stronger, as I mentioned it earlier on, as a hybrid strategy. And last but not least, I think we need more openness on technology and technology neutrality, competition, innovation. And I think Lucas mentioned it at the very beginning, the technologies for 2050s are not there yet. So we need that push on innovation. And that's something, honestly, being in the business for many years, is nothing I've ever seen coming from governments or institutions. That's something for startups, for engineers, for innovators, bringing that. And so my wish would be that the Commission would concentrate more on enabling conditions rather than regulating all the details of upcoming technologies.
Thank you for that. And the gentleman in the second row. Maybe very quickly, please.
Yeah, one sentence, which is not a comment, but it's an additional wish list, just to say that the EU is one of the global regulatory superpowers, and it's the largest exporting bloc in the world trade. We are running the competitiveness agenda. There are heavy demands on what industry policy should do, how single market should be run. And we are doing this with a budget which is just marginal if you look at member state spending. So maybe, given the very high expectations of what the EU should deliver, the decision makers who decide on the next multi-annual financial framework should also look at what financial resources may be needed to run this agenda. Thank you.
A plea from the Commission to itself. Second row.
Well, Javier Arias, I'm actually a president of European League for Economic Cooperation, and I'm a former banker, so I want to probably choose to step up on this note on banking. I think that banks, they are part of the solution. They are not really the problem. And in this sense, I want to probably to further enhance the importance of the internal markets. I think that we had moved from internal market to capital markets union and the likes. And now I think that's really the big problem in my view is the how we have to further remind to everyone that the internal market probably is one of the best assets we have in Europe, alongside with the euro, although not all European countries, they are part of the Eurozone, but this is a very important thing. Second, why politicians or leaders, they are hesitating on addressing the traditional structural reforms? Why never is the time ripe enough to further enhance the not, I would say, not the rules, but strengthen the internal market. When I meant strengthen internal markets to accomplish the banking union is to have a capital markets union which is performing well in the times when we are in a process to reset our economic model. And I think that this business case, which was meant earlier, should be addressed to those political leaders, in the sense that...
And your question, sorry?
My question is, how much time do we need to do that? I think that time is running out, and maybe we don't have even 5 years to go. We need to do that in the next couple of years. And I think that in this sense, the decision-making process and the regulating process probably should be to shorten in this new framework. So that's my plea. Maybe that would be a reflection for the for the next commission.
Not really a question, but okay, thank you. And then the gentleman behind who had a question also, please. Yeah.
Clemens Schuster, running actually a startup, AI-driven policy monitoring. Yeah, I think you can't have the cake and eat it at the same time. So again, complaining about lacking innovation, lacking fundings, I'm speaking exactly about myself and suffering from that. At the same time, being confronted with quite a lot of regulation coming up. Everyone again made the jokes about, yeah, US innovates and EU regulates and all that stuff. We know that meme. For example, when it came to the AI Act, yeah, or now the Sustainability Directive into place. What I really ask for, and that is exactly it, for, let's say, large companies and large industries like right now on the podium, you actually would have much more power in that sense of enabling that innovation by either explicitly funding these startups and not just going for the quick and easy thing. So you need to go for that high risk with the high ability of loss, because that just means the question of investing. So please just be more brave by yourself. That would be a request.
Okay, again, I think we can probably wrap it up there unless panelists have further comments. But very broad discussion. We wanted to tackle the issue of how can we enhance your competitiveness going forward? How can we harness the single market even further? We heard and we've seen and read and written for some of us many lists on how to achieve that. There is political momentum definitely behind some of these issues. We will see with the reports that are coming up and EU elections and the narratives that will be shaped in the run-up to the election of the next commission. But I wanted to thank you all and give you a round of applause for participating today, and thank you very much for the audience.